Right now, in 2026, less than a quarter of actively managed funds have beaten a simple index tracker over the last 10 years. For UK equity funds, it's even worse. In 2025, 88% of broad UK equity funds failed to beat their benchmark, and for UK small cap funds, that figure was 97%. That's not a hot take from a personal finance blogger. That's the picture you get when you look at AJ Bell's Manager versus Machine report, alongside the latest UK SPIVA style data. And it shows just how hard it has become for active funds to justify their fees over time. If you've ever felt like picking your own stocks, or paying someone else to do it for you, was the smart, grown-up way to invest, those numbers should make you pause. Here's the thing though. This isn't just about one bad year. Year after year, active fund performance has continued to disappoint, and for a lot of investors, that has come at a very real cost. I'm going to show you what that cost actually looks like, and then give you the one honest answer this debate usually skips over. We're going to run the real numbers on stock picking versus index funds in 2026. Look at the hidden costs nobody talks about, and land on the single factor that actually decides which side wins for you. And I want to flag something now that we'll come back to later, because it quietly removes one of the biggest reasons people felt they had no choice but to go it alone. Something changed in the UK on April 6th, 2026. I'll get to that. But first, the obvious comparison, because it's where everyone starts, and it's the wrong place to start. The pitch for stock picking always sounds the same. If you'd bought Nvidia in 2015, you'd be sitting on a fortune. That's true. It's also the wrong way to evaluate anything. It's like judging how safe driving is by only interviewing the people who didn't crash. Of course you can find someone who won. The question was never whether stock picking can work. Obviously it can, for someone, some of the time. The real question is whether it works reliably enough, for enough people, to be worth the risk and the fees compared with simply buying the whole market. And that's what the numbers actually answer. But most people only ever look at one number, the fund's advertised return. So let's fix that, because there are at least 4 real costs stacked underneath that headline figure, and most people only ever see one of them. The first is the fee gap. A typical actively managed UK fund charges an ongoing charges figure of somewhere between 0.5% and 1.5%. A comparable index tracker often charges between 0.04% and 0.23%. On a £20,000 ISA, that gap alone can cost roughly £100 to £250 a year. Every year, compounding, whether the manager beats the market or not. You pay that fee regardless of the outcome. The manager gets paid either way. The second cost is the behavior gap, and this one is bigger than most people realize. Investors often underperform the funds they own because of timing. They buy after a rally when confidence is high, and they sell after a drop when fear kicks in. In strong years, the gap can still be painfully large because the mistake is usually behavioral, not structural. Retail investors have a habit of turning perfectly good investments into poor results by repeatedly doing the wrong thing at the wrong time. Third, trading costs and tax drag. Every time you buy or sell individual shares or switch funds outside a tax wrapper, you can trigger dealing charges. And outside an ISA, you're looking at capital gains tax on top of that. Frequent trading compounds both costs quickly, and most active stock pickers trade far more often than they should. Fourth, and this one is the sneaky one, survivorship bias. Many studies ignore funds that disappeared during the period being measured. The honest analysis includes them, which gives a much more realistic picture of the whole market. A meaningful share of active funds don't even survive the period they're compared over. They get merged away, rebranded, or quietly shut down when performance is poor enough. When you're picking individual shares yourself, the equivalent of the fund disappearing is simply your pick collapsing in value. Most people who tell you stock picking worked for them have only ever looked at the return. Nobody shows you the other three costs sitting underneath it. So here's where it gets interesting. Because I said there's one thing that actually predicts whether stock picking or an active fund manager beats a simple index tracker. And it isn't intelligence. It isn't hours spent reading earnings reports. It isn't conviction in your thesis. It's time horizon and sample size. Specifically, how many independent bets you're making, and how long you're giving the process to play out. Over 1 year, some active categories do genuinely beat their benchmark. In a few pockets, active managers have had a real, persistent edge. But stretch the window out, and the odds don't stay flat. They get worse. Over the past 10 years, only 21% of active managers have outperformed passive funds in AJ Bell's latest report, a new low for the series. And that's not because fund managers got stupider. It's because beating the market isn't a single bet. It's a bet you have to keep winning, year after year, after fees, without missing too many turns. The longer the horizon, the more the fee drag and the odds work against you. Now, and this is the part I flagged at the start, the thing I said we'd come back to. The odds aren't uniform across every corner of the market either. Just like buying a house isn't one national decision, active versus passive isn't one universal verdict. In 2025, 97% of UK small-cap equity funds failed to beat their benchmark. But fixed income has historically been a more competitive arena for active managers than equities, because bond markets are less picked over and often less efficient. In some fixed income categories, active managers have had a better chance of adding value than they do in mainstream equity markets. So the category you're actually invested in matters. But mainstream UK and global equity, where most people's ISA money actually sits, is exactly where the odds are worst for stock picking and active management. Here's a test you can run on any fund you already hold right now. Look up its OCF, ongoing charges figure. It'll be on the fund's fact sheet. Subtract the cost of a comparable index tracker, call it 0.1%. That gap is your manager's hurdle rate, the amount they need to beat the market by every single year after fees, before you're even level with just buying the tracker. If your fund charges 1% and the tracker charges 0.1%, your manager needs to outperform by more than 0.9% a year, consistently, just to break even, before behavior, before tax drag. Right now, only 21% of active managers have outperformed over the past decade, and in the first half of 2026, just 22% of globally active equity funds beat passive equivalents. If you've got a fund you've been paying for without ever running that check, that's the first thing to do this week. Drop the name of your fund in the comments, and I'll try to help you work through it. Now, here's the thing I flagged right at the start, the thing that quietly changes the picture for a lot of people in this country. For years, one of the strongest reasons people gave for picking their own stocks, or chasing a star fund manager, was, "There's no one else helping me, so I have to do something." And that was a fair point. Regulated financial advice in the UK has typically been expensive enough to put it out of reach for many ordinary investors. The FCA has estimated that millions of consumers are underserved by the advice and guidance market, and it's been addressing that gap by creating a new form of support: targeted support. So millions of people were left to either do nothing or teach themselves to pick stocks, often via forums, apps, and finfluencers, because the regulated alternative simply wasn't accessible. On 6 April 2026, the FCA's new targeted support regime went live. The new regime allows authorized firms to make suggestions to groups of retail clients with common characteristics to help them make better decisions about pensions and investments. It sits between generic guidance and full regulated advice, and it is designed to help firms give more tailored support without crossing the line into personal recommendations. It isn't full personalized advice, but it is a genuine, regulated step up from a generic warning and a good luck. And it removes a big part of the reasons so many people felt forced into doing it themselves out of necessity rather than choice. If part of your reason for stock picking was, "No one else is going to help me figure this out," that's now less true than it was before April 2026. It's worth checking what your own platform can actually offer under the new rules before assuming you're on your own. While we're at it, let's deal with the "index funds are boring, you're settling for average" line. Because it's the same trap as rent is dead money. It only sounds true if you ignore what the alternative actually costs. Average, in this context, means owning the whole market. Every eventual winner and every eventual loser, for a fee that is usually a fraction of what active funds charge. Better than average means paying several times more for a bet that, on the latest UK data, produced poor results again in 2025. Calling that ambitious rather than average is a branding choice. It's not a financial argument. To be fair to the other side, because this channel isn't here to dunk on anyone, some of these numbers do have real methodological pushback. There are genuine pockets, particularly in certain fixed income segments and smaller, less followed markets, where active management has had a real edge because those markets are less efficient and less picked over. And some analyses suggest the headline picture softens a bit when you weight results by fund size rather than counting every tiny fund equally. So, index funds always win everywhere for everyone isn't quite right either. But for the core of most people's money, mainstream UK and global equities, the bit actually going into an ISA every month, even the more generous reading of the data still leans clearly toward low cost and diversification. Since 2022, tens of billions have flowed out of active strategies as investors have moved toward lower-cost index trackers. And that's not a trend driven by people who haven't done their research. It's driven by people who have. So here's the honest, segmented answer, because this isn't one size fits all. If you're investing mainstream money for retirement or a house deposit 5 or more years out, a low-cost global index tracker inside a stocks and shares ISA should be the core of it. The odds are stacked against active picking, clearing its own fee hurdle year after year in exactly the categories where most people's money actually sits. If you genuinely enjoy researching individual companies, fine, but ring-fence it. Treat it as a small, separate slice of your portfolio you could afford to lose entirely, not your retirement plan. And track your own results honestly against a tracker, rather than only remembering the winners. That last part matters more than most people want to admit. If you've been paying for an actively managed fund without ever checking whether it's actually cleared its own OCF hurdle over 5 to 10 years, run the test I just walked you through. Look up the OCF, subtract 0.1%, and ask whether your fund has beaten that hurdle consistently. If the answer is no, you now know what to do. And if the only reason you've been doing it all yourself is that you didn't think any other help was available. That's now less true than it was before April 2026. Check what your platform can offer under the new targeted support rules before assuming you're flying blind. The question was never, can you pick a winning stock? Some people can, for a while. The question is whether doing it reliably beats buying the entire market for a fee that is far lower. And for most people, in most of the categories that actually matter, the answer is still no. If this changed how you look at your ISA, subscribe, because this is exactly the kind of thing we cover here. The actual numbers, not vague takes. And if you want to see the other side of this, the UK savings stats that almost everyone gets wrong, that video is right here. Watch that one next.